So let's bring in here the chief economist of HSBC in Australia, Paul Bloxham, a former economist at the Reserve Bank as well. Look, I got a sense of the strategy today, and that is accept inflation, higher inflation for longer, out until 2025, and that's to try and protect jobs. Is that your sense as to what the strategy is right now?
I think it is. The RBA has had a flexible inflation target now for 30 years, over 30 years. They set it in 1993. And amongst the central banks across the world, that's the longest period of any central bank having had a flexible inflation target.
Do you think 9 months out of 79 months, is that a reasonable score or is it not a reasonable score?
Well, again, as the Governor pointed out, the objective here is that it gives you a guidepost as to where inflation should be on average. It's not where you should be all the time. And in fact, as you point out, they haven't been in the target band very much in recent times.
Like they've barely hit the bar.
Well, this is true, but they, as you say, have averaged it. And the key thing is that you get back to it.
But surely having big overshoots or big undershoots, that's got to be damaging for the Australian economy as well.
Well, so let's talk about how they got there. The undershoot was because we had this long period globally of very low inflation, and the RBA didn't want to cut the cash rate to zero or negative. They were worried about how that might overinflate the housing market, and that was a choice they made pre-pandemic. And then, the overshoot has come about because, as the Governor pointed out, we've had these really, really enormous shocks. A once-in-a-century pandemic, big fiscal monetary stimulus, and then all the supply shortages that come along as well, plus the Russia-Ukraine war, so there's a lot of reasons for how it's been so volatile. So actually, I would argue that the strength of the system that we have is one that allows it to be volatile around an average. You can't change, that inflation was going to spike a lot on the back of the developments we saw. What you can say is, look, we have to credibly get back there over time. Now, if you draw that out a little bit further, some central banks, the RBNZ today...
Yes, let's go there.
Exactly. The RBNZ's approach is, no, we have to get that back there really quickly. And that doesn't matter. If we have to have a recession to get there, that's just the way it works. And so we think the RBNZ's already delivered one. We think New Zealand's already in a recession. So that's another choice. A choice you could make is slam the brakes on, lift interest rates substantially, get you back down to your inflation target much, much faster. And the Governor of the RBA is saying, look, we've had a flexible inflation target for a long time. We're pretty comfortable with the idea that we can be above and below for long periods, as long as we really do believe that we will get back there, and as long as the community believes that.
So I've got a funny anecdote for you. So you might have heard him there saying that this 2 to 3% target is the anchor, right? Now, he used to actually call it the North Star. When it was below, inflation was well below 2 to 3%. He used to say that's our North Star. That's what we're aiming for. But of course, that's when inflation, the target was above it. Now that it's below, he's now calling it the anchor. So that was a little funny thing.
I think that's true, but I think the guideposts are reasonably clear.
OK, so there's one other aspect to this. My sense is that if all of a sudden commodity prices, or wages in particular, break out, that the Reserve Bank Governor is determined and absolutely determined that they will slam the brakes on and start raising interest rates again. And people have got to be aware of that.
I think that's right. They're pausing. So the next move could still be up. It could still be down, but they've paused because they need to assess the impact of the tightening they've already delivered. They've moved super fast. They've moved 300.
So that means unions and government and everybody with wage rises have to be very, very conscious of that. Because if there is a wages breakout, there's no doubt the Reserve Bank will hit the economy with higher interest rates again.
Yeah, and I think that's more important than the commodity story. I think the commodity story you can look through. I think if you get a spike in oil prices, you could say, look, unless it gets through to inflation expectations, unless it embeds itself in the economy, it's less important than the wages story. That's a critical feature of why I think the RBA has been able to move more slowly than other central banks. We've gone 350, the RBNZ's gone 475, the Fed's gone more, the ECB is likely to go more as well. Why? Because they've got a bigger wages problem than we've got. We've seen a pickup in wages growth, but it hasn't yet gotten to uncomfortably high levels. And so that is affording the RBA the opportunity to be able to take it a bit easier, try to protect some of those jobs. If wages growth does pick up more and more quickly and get to an excessive level, then you're right, the RBA will have to do more.
OK, so let's listen again to Philip Lowe today, just explaining exactly that scenario.
If we need to keep interest rates high for longer to make sure that inflation comes back to 2 to 3% reasonable range, reasonable time, we'll do that. But that will be determined by the flow of events, won't it?
That's as honest as it can be, right? So in other words, he's prepared to go, but it depends on what the information comes out of.
That's right. Look, our view is this. Our view is actually they've moved a lot and we've yet to see the full effect of it. And we've got this big shift for people off these fixed rate mortgages onto variable rate mortgages. It's a big step up, I think, in terms of what it's going to do to the household sector. We're already seeing consumption start to weaken. We think it's going to weaken more. So we don't think the RBA will probably have to deliver more. and we think they will be in a long pause. But, there's certainly two-sided risk.
All right, but the risk is there because, and let's be honest about it, because you can see how aggressively New Zealand has gone. You can see how aggressively the United States has gone. You can see where the ECB and the Bank of England are going. And yes, they may put their economies into recession. He's trying to tiptoe his way out to protect the jobs. That's what really seems to be the hallmark. And he believes also the second thing is that the interest rate moves are having more impact here because so many households have variable rate mortgages.
That's right. So we have a more powerful tool in the short run, and we're likely to have that effect much, much earlier. And so that's one aspect of it. And then I think the other fundamental aspect of it is that they're not seeing the inflation feed into the wages process in a way that is lifting wages in an uncomfortable way. I mean, the wage price index is running at 3.3, up from 2%. If it starts running at something in excess of 4%, then that's worrisome. But we're not there yet, and we may not get there. It may be that the tightening they've already delivered softens the growth story, slows down the labour market, and means we don't get an excessive pickup in wages growth. And don't forget, the rest of those central banks are all busy lifting interest rates too, and they're delivering downturns in their economies. And so a global downturn may also be disinflationary.
Tell you what, it's going to be interesting just to watch this out, but it is a moving feast. There is no doubt. Paul Bloxham, it's always great to get your input, and many thanks for your time today.
Great to be here.